Imagine this for a second. You wake up one day, check your investments, maybe your retirement savings, right?
Okay.
And you find out they're caught up in a company that's just collapsed, allegedly full of fraud.
Oh, wow.
Billions lost for thousands of investors. And then you learn that a huge global auditor, one of the biggest names, had given that same company a clean bill of health year after year.
Yeah, that's the really alarming part, isn't it? The sheer audacity of the alleged deception.
Exactly.
And it just raises these critical questions about, the trust we put in auditors. Are they really safeguarding the market?
That's precisely what we're digging into today.
Mm-hmm.
This deep dive, it's focused squarely on this massive $1.4 billion lawsuit against Ernst Young EY.
Right, EY.
And it all stems from their audit work for a private lender called Bridging Finance, Inc.
Bridging Finance.
So yeah, this isn't just like a story of a company folding. It's really about the auditor's role and maybe some cracks in the whole financial oversight system.
So our mission here, our goal for this deep dive is pretty clear. We want to unpack the main allegations against EY. We need to look into this web of deception, as it's being called, supposedly inside Bridging Finance.
Right. That phrase keeps coming up.
And understand the specific ways, almost clever ways, they allegedly hid how much financial trouble they were really in.
And the human impact, too.
Absolutely. Explore the impact, which was often devastating, right, on thousands of investors, and then zoom out to the bigger picture implications for, well, financial trust and accountability.
Yeah.
And we're drawing all this from recent, pretty detailed reporting on this huge legal fight.
Okay, so let's start with the company itself. Bridging Finance. Who were they exactly? What was their business? And I guess what made them vulnerable to this kind of alleged fraud?
Well, Bridging Finance, Inc., they were actually a pretty big player up in Toronto's private lending world.
Really?
Yeah, managed over $2 billion in assets at their peak. They specialized in what you'd call alternative loans.
Alternative loans.
Yeah.
So riskier stuff.
Basically, yeah, high-risk loans, often given to borrowers that, traditional banks probably wouldn't go near. Now, on the surface, that sounds like a niche, maybe even profitable business if you manage the risk properly.
Right. If. And that seems to be the key point here. A firm dealing in high-risk loans allegedly layered on even more risk with systematically misleading accounting. The lawsuit claims EY, as Bridging's auditor, kept issuing clean audit opinions for 6 straight years, 2014 to 2020.
6 years. Wow.
Yeah, and this was despite what the court-appointed receiver, it's PwC in this case, the firm brought in by the court to sort things out and recover money.
Right, the receiver.
PwC claims there are very clear warning signs all along.
Okay, so clear warning signs.
Yeah.
What kind of things are we talking about? What specifically should an auditor like EY have been looking for that PwC says they missed?
Well, this is where it gets really concerning. PwC argues that Bridging's top bosses, a husband and wife team, David and Natasha Sharp,
The Sharps.
they were allegedly right at the center of it, reportedly using misleading accounting tricks, basically to puff up the value of their funds and pull out excessive fees for themselves.
The human angle here, the people allegedly behind it, is pretty startling. And if you connect that to the bigger picture, Ontario's Capital Markets Tribunal, it's the province's main securities regulator, they actually found both Sharps guilty of fraud and regulatory obstruction.
Guilty.
Okay. Yes, the tribunal called it, and I quote, one of the most grievous cases they'd ever handled. David Sharp got hit with a permanent ban from Ontario's capital markets.
Permanent ban. That's serious.
Very. Interestingly, though, Natasha Sharp, his wife, she still has limited trading privileges, but under, very specific court-ordered conditions.
That's a big difference.
Yeah.
Given how severe the tribunal described it, why would Natasha Sharp still have any trading privileges, even limited ones? What's the reasoning there?
That's a really good question. It kind of highlights how these legal and regulatory outcomes can get nuanced. Even though both were found guilty, maybe the specifics of their individual roles or perhaps different legal approaches could have led to different penalties. Sometimes, a regulator might impose a more limited ban if they think the person's involvement wasn't quite as central, or maybe if specific conditions can, in their view, prevent future problems. It's about proportionality, sort of, even when the findings are really serious.
Okay, that makes sense. So how did they allegedly pull this off, these misleading practices? And how did EY supposedly miss it?
Right.
The lawsuit gets specific. It points to EY failing to properly investigate, bridging's use of something called payment-in-kind loans, or PIK loans.
Ah, yes, PIK loan.
For anyone listening who isn't familiar, can you break that down? What's a PIK loan?
Sure. So with the PIK loan, the interest payment isn't actually paid in cash by the borrower.
Oh.
Instead, that interest amount is just tacked onto the original loan balance. So the debt just keeps getting bigger and bigger. It compounds. Exactly. And the crucial thing here for auditors is that PIK loans can be a huge red flag.
Why is that?
Well, it's a way for a company to make it look like they're earning revenue on paper, because the loan balance is growing, but without actually getting any cash in the door.
Right, no actual money coming in.
Precisely, which often signals that the company might be having trouble with liquidity, with actual cash flow. So for an auditor, seeing a lot of PIK loans should trigger some serious questions like, is this company really solvent? Or are they just digging themselves into a deeper hole by piling up more debt they maybe can't repay?
Okay, so that's the PIK loans.
No.
What else?
Well, beyond the PI clans, the lawsuit also specifically alleges that EY overlooked what are called loan risk misclassifications.
Loan risk misclassifications.
Okay.
What does that mean, and why is it a problem for an auditor?
Okay, imagine you have a loan that's actually super risky, maybe to a shaky startup, right? Very speculative.
Yeah.
Now imagine you classify that loan on the company's books as if it were something really safe, like, say, a low-risk government bond.
Okay, completely misrepresenting the risk.
Exactly. This misclassification drastically understates how much risk the company is actually exposed to through its assets. It also understates how much capital they should be holding against those risks. It just paints a dangerously rosy picture for investors.
So let me get this straight. You've potentially got these PIK loans, making revenues look inflated and hiding cash flow problems.
Right.
And you've got misclassifying the riskiness of those loans, making the whole balance sheet look stronger than it really is.
It's like a double whammy of alleged misrepresentation, yeah.
Wow.
Both of those things, the PI loans and the risk misclassifications, if true, would have seriously distorted bridging's actual financial health, essentially masking its decline, making it look way more solvent than it was.
And this really raises that question about, how deep does an auditor need to dig beyond just what the company hands them?
It certainly does. It's about looking at the underlying reality, not just the surface presentation. Now, it's important to note, EY has responded. They've stated they stand by the integrity of their audit work.
Right.
And they plan to defend themselves legally. They've said they take their responsibilities seriously, so there's definitely another side to this story that will play out in court.
Okay. And the impact, it's just sobering when you think about the real people affected. Over 26,000 investors caught up in this scandal.
Yeah.
We're talking billions lost.
It's a huge number. The original funds under management were over $2 billion. Now, PwC, the receiver appointed back in 2021 by the Ontario Securities Commission, they have been working hard to get money back.
Any success there?
Some, yes. As of last October, they'd recovered about $698 million. And just this past April, a court approved an initial payout to the unit holders, that's the investors, basically of $321 million.
Okay, so some money is flowing back.
Some. PwC estimates the total recovery might reach up to maybe $880 million.
But even $880 million, that's still way, way short of the original $2 billion plus, right?
Right.
Leaves a massive hole.
A huge gap, absolutely.
So this lawsuit against EY, it's not just about pointing fingers or accountability, is it? It's also about trying to recover more of those lost funds, trying to fill that gap left by what the lawsuit calls a, catastrophic audit failure.
Precisely. The recovery efforts by PwC are definitely still ongoing, running in parallel with this very public, very high-stakes legal battle to figure out who's accountable for what went so wrong here.
This case, it really does put a spotlight on a critical tension in the financial world, doesn't it?
How so?
Well, on one side, you got a company. It needs capital, right, to operate, to grow. That's fundamental.
Sure.
But then on the other side, you have the auditor. Their job, their absolute duty, is to independently verify the financial health of that company. They provide that essential layer of trust for the whole market.
Yeah, that's the ideal. And then you have the investor, right? The third piece. They rely so heavily on that verified, accurate financial reporting to make smart decisions about where they put their money, their savings.
Exactly.
So the challenge here, it isn't just about catching outright fraud, though that's obviously part of it. It's also about ensuring the very systems designed to prevent this kind of thing, like strong independent audits, are truly robust, that they're impervious, you could say, to the temptation of hidden risks or maybe inflated numbers.
Right.
It really seems to demand constant vigilance, maybe even a healthy dose of skepticism from absolutely everyone involved in the financial ecosystem, companies, auditors, regulators, and investors too.